Sai Ram, dear students, welcome to this session under National Income Accounting. Let us discuss today the macroeconomic identities. The objectives of this lesson is to understand the basic concept of factor cost, basic prices and the market prices, and also to understand the concept of macroeconomic identities. Because we are going to study the measurement of GDP. When we say the measurement of GDP, we know we have studied already the methods of measuring in national income or GDP, all the product method, expenditure method and income method. Now, at what basis we are going to really quantify it? Really, we can't add 100 tons of wheat with 200 tons of rice and 1,000 automobile cars and trucks together like that. Different commodities cannot be added together. The value of each commodity should be converted into money value in terms of money. Then only it is valuation is very easy. Otherwise, keeping the commodity as such, we can't compare the GDP for different years. For that purpose, we have to value or evaluate the commodity products and goods and services based on factor cost or based on basic prices or based on market prices. For that purpose, we have to study what is factor cost. You know, the money value of final goods and services will be estimated in two ways. One is factor cost, other one is market prices. We can say we can value at a factor cost or we can value at market price. That is how we estimate GDP by evaluating the goods and services produced for a year either at factor cost or either at market price. We will see what is factor cost. Factor cost is nothing but is the payment done, all the payment done by the firm or the production unit, because firm is nothing but a production unit, and paid by this firm to the factors of production. That is called factor cost. Therefore, factor cost is the cost incurred for the utilization of factors of production. Therefore, the cost is nothing but, we have already studied, it is paid in the form of wages for labor and in the form of rent for the land, it is a factors of production, and interest for the capital, it is another factors of production, and profit, it is for the entrepreneurship. Well, that is one of the factors of production. Therefore, the factor cost is nothing but all the payment done by the production unit of firm to the factors of production in the form of all these wage, rent, interest, profit. I hope you understood what is factor cost. Therefore, GDP is measured in terms of factor cost. You should understand only the factor cost for the factors of production taken into consideration. And factor cost does not include any tax. We will see in the market price. Market price will include the taxes. Therefore, factor cost doesn't include, it excludes the taxes, subsidies, everything. And therefore, market price is the price at which commodity is sold or purchased. Whatever we are paying to buy an item is nothing but market price. When we pay, for example, I'm buying a sari. When I buy a sari, I pay a price 1,500. This 1,500 not only includes the factor cost, but also it includes the taxes. Therefore, the market price is the price which is paid by the consumer. Is while purchasing or selling, it is called market price, and it is the price consumers pay actually. What is the price we pay? We all know nowadays, whatever we pay for any biscuits or any milk or any item, we are paying including GST, taxes, everything is included in our bill. You can see so many taxes, GST, goods and services tax and CGST, so many taxes will be below after our account, our amount is over. Then in addition to that amount, with that additional amount, whatever the taxes included will be mentioned at the end of that bill. Therefore, we can notice that is nothing but market prices, because it includes all the taxes. Therefore, the price what consumers actually pay, really not the producers actually get, because whatever we pay the producers, we pay including taxes. What producers get is, he deduct the taxes he is going to pay to the government, because government get the taxes from the producers, and that whatever we pay, the tax is excluded when producers get it. Therefore, market price in the sense, consumers, whatever consumers pay for actually. And market price is nothing but factor cost plus total indirect taxes minus total subsidies, because indirect taxes are added to the factor cost and subsidies are deducted. We will see what are the indirect taxes. There are two types of indirect taxes. Because it is called indirect taxes, unlike income tax, it is a direct tax paid by the people directly to the government. But indirect taxes are included with the prices of the commodity itself. That is what it is called indirect taxes. There are two indirect taxes, net production tax and production tax. We will study. Net production tax mean indirect tax minus subsidy, but it is one is involved with the production and other one will be involved with the product. We will see that one. The distinction between factor cost, basic prices and the market prices depends on the distinction between the taxes. What are the taxes? Net production taxes. When we mention net production taxes, it refers to the production taxes less production subsidies. You know, the production taxes in the sense, for the virtue of production, you know, without considering the volume of production, only for the production, there are taxes and also there are subsidies. For instance, production taxes, I can take land revenue. The land revenue doesn't depend on the volume of production or the volume produced, that is in terms of product. It just land revenue is levied or charged on land which is used for agricultural production. Therefore, production taxes is just for the virtue of production. In the land only it is levied, not on the volume of production it is charged. Therefore, production taxes minus production subsidies. You know, sometimes government gives subsidies to encourage the farmers to produce. For example, any small industries in very backward area, they will get the subsidies. And for example, railway subsidies is given. And you can see even for any gasoline subsidies or gas subsidies, these are the examples for the small industries. They can give production subsidies. Therefore, net production in the sense, when you production taxes is, you deduct the production subsidies from the production taxes. Less mean minus. Production taxes, net production taxes is nothing but production tax minus production subsidies. Therefore, when you get the term net, you should understand you are deducting production subsidies from the production tax. It is referred to as net production tax. I hope you understood. And we have another one tax is called net product tax. This is production tax on land revenues, stamp duty, registration fee, stamp duty. For instance, it varies, stamp duty or stamp fee state to state. That stamp fee, in the sense, you have to pay a part of the worth of amount of money to the land registry, or the people make the documents and all. But it depends on the value of the property. 1% of the property value or the 2% of the property value is charged as stamp duty. It is on all included as production taxes. And registration fee. The land, when we get a land for the production, you have to register. That also mostly 1% of the property value. That goes as a tax for the land. That is all only for the production taxes. But these production taxes are not dependent on volume of the product produced or the volume of production. And other important example is land revenue. It's charged on land. It is fixed for the land, not for the production. Only for the land which is going to be utilized for the production. And net product taxes, in the sense, This one, product tax minus product subsidies. Product tax less product subsidies mean it is nothing but it is equal to product. There we used product production. Here we are going to utilize product tax minus product subsidy. Product tax minus production subsidy is nothing but net product tax. Net product tax is equal to product tax minus product subsidy. When you deduct product subsidy from the product tax, then we will refer it as net product tax. Where it comes, net product tax means it absolutely depend on the volume of product. For each product, for example, product tax per unit of pen production, product tax per unit of milk, per liter milk, that like that. Product tax, it is depend on the volume of product. Maybe in the unit basis or percentage basis, it is charged for the product tax. And next one, production taxes and subsidies are paid or received in relation to production. What is that? Taxes mean, product taxes mean it is paid. Subsidies mean it is received. I told subsidies. For instance, the subsidies given for the product taxes, product subsidy I can take paddy production. Always fertilizers are subsidized. How? For instance, fertilizer price for a bag is 350 rupees. But the government will bear the half the charge of fertilizer, half the cost of the fertilizer, 175 rupees or to 150 rupees borne by the government. Only out of 350 per bag, 250 or 200 rupees borne by the government. The rest of the amount will be paid only by the farmer. That is what the consumer's price will be declined. Otherwise, farmer pays more cost for the fertilizer, then the product cost also will increase. Therefore, it will give her to encourage the farmer, paddy farmer or wheat farmer, to encourage them for the production of the wheat production or the paddy production or the vegetable or any cotton production. What government does? Government subsidize the seed subsidy, fertilizer subsidy. Everything is given in the subsidized rate. I hope you understood the concept of subsidy. If it is a 150 rupees per bag fertilizer cost, only 75 rupees paid by the farmer and the rest of the 75 rupees paid by the government. Therefore, only half the cost is paid by the government. Thereby, paid by the farmers. Thereby, farmers always would be encouraged to produce more and more, and also consumers also will be purchasing more and more, because that will not be. Example for the production taxes: land revenues, stamp and registration fee. I told land revenue mean the tax levied on land. It is fixed amount. It is on land, not on the volume of production. And the stamp fee, and it is varies state to state. And the registration fee on the that also it 1% of the total property value. And the next one, product taxes and subsidies are paid or received per unit or per unit of product. Commodity per unit, maybe. That is, product taxes mean taxes are paid, subsidies are levied. And example, excise tax, service tax, these are the product taxes. Excise tax mean it is for specific goods. For instance, when we buy a liquor or the tobacco cigarettes, we have to pay including this tax. Therefore, cost will be more. Our cost of purchasing that particular liquor or the tobacco would be more, or gasoline. That is, in the consumer's payment only, when we purchase only, we are paying taxes including the price of the commodity. It is called excise. It is specially on particular goods like liquor, the tobacco, like that. And service tax, we are using all the credit card, debit card. For that, government always charges service tax. And export and import duties, the tax on export will be called as export duties. Tax on import is called as import duties. These are the example for the product taxes. These are the example for the production taxes. Land revenue, stamp, and I hope you understood. And basic prices. Basic prices include the production taxes. That means when you say production taxes, less production subsidies. Basic prices include the production taxes less production subsidies, but not product taxes less product subsidies. Therefore, basic prices only include production taxes. What do you mean by production taxes? Production taxes, I have already explained, that is land revenue and the stamp and registration fee. Basic prices in the sense, it is basic prices only take into consideration production taxes. Production tax minus production subsidy. Production subsidy. But it doesn't take this part. Product tax minus product subsidy is not considered for the basic prices. That is the difference between the basic price, but that is basic prices. Basic price only include production taxes. And now, the Center for Statistics, this office statistics or this office of the government, India government, now releases GVA at basic prices. That is, we have studied GDP can be given based on GVA in the value added method or in the expenditure method C plus I plus G plus X minus M. But the Center for Statistics office under India government now release the report for GDP based on GVA at factor prices. When you see a report mentioning GVA at basic prices, at basis or factor prices, basic prices, you will automatically understand it is nothing but GDP measured for a particular year at basic prices using value added method. What is GVA? Gross value added. Gross value added, or otherwise we say what? Product method. Gross value added method of measuring GDP. Therefore, nowadays, after 2015, the government in India, the Center for the Statistics Office, it releases GDP in the form of GVA, gross value added at basic prices. Then basic prices is what? Basic, we will see the next one. Therefore, GVA at basic prices is now what? GVA at factor cost minus net production taxes. GVA at factor cost, GVA at factor cost means the cost incurred for the factors of production. Cost incurred for factors of production plus net production taxes. What is net production taxes? We have studied net production taxes, nothing but production tax minus production subsidy. When you deduct subsidy, production subsidy from production taxes, it is called as net production tax. Therefore, GVA at basic prices is nothing but this only, factor cost plus net production taxes. I hope you understood. Therefore, if the Indian government releases GDP at GVA at basic prices, gross value added at basic prices, what do you mean by that? That means it has included GVA at factor cost plus net production taxes. And GVA at market prices. GVA at market prices mean what? Basic prices, because already we have calculated GVA at basic prices plus net product tax. Now it includes only for market price we are coming in addition to net production taxes in the basic price. Now GVA at market price include GVA at basic price plus net product taxes. What do you mean net product tax? Net product tax. Product tax minus product tax. Net product tax is nothing but net product tax is nothing but product tax minus product subsidy. Product tax minus product subsidy. I hope you understood what is the difference between basic prices and market prices. Basic price include with the factor cost, GVA at factor cost plus net production taxes. Market prices include basic price, GVA at basic price plus net product taxes. I hope you understood. Now I am going to say some macroeconomic identities. We have finished the concept of factor cost, basic prices and the market prices. Now we are going to the second part, GDP, some macroeconomic identities. This question always used to be asked as a long answer question, 6 marks, 20 sentences. You have to explain the macroeconomic identities. What are the macroeconomic identities? But that we are going to study. The first one, GDP, market price. You know what is market price? We have already told. Factor cost plus net production taxes plus net product taxes. And therefore, GDP market price is the market value. That is very important. You have to write. GDP is the market value of all final goods and services. No, by final goods, not intermediate goods. Final goods and services produced within the domestic territory of a country measured in a year is called GDP. That you all know what is meant by GDP. That is the definition of GDP. Here, the GDP market price is denoted by C plus I plus G plus X plus M. This we have studied, that is expenditure method of measuring GDP. And that you know, this and all you have to write for the answer as a macroeconomic identity. What is this macroeconomic variable GDP market price is equal to what? The second one, GDP factor cost. I told factor cost mean it only include factor cost mean only the payment for factors of production. It doesn't include taxes. Therefore, you have to deduct NIT. A market from the market price, because market price include taxes, but factor cost doesn't include taxes. It includes only merely factor payment. Therefore, you have to deduct all the net indirect taxes. What is net indirect taxes? Net indirect taxes nothing. Net indirect taxes is equal to NIT mean N stands for net, I stands for indirect, T stands for taxes. Net indirect taxes mean indirect taxes minus subsidies. You know what are the indirect taxes? We have studied two taxes, production taxes and product taxes, as well as production subsidy, product subsidy. Therefore, when you deduct from the market price, GDP market price, NIT, that is the indirect taxes subsidies, you will derive GDP factor cost. This also you have to write as a macroeconomic identity. And NDP mean net domestic product at market price. What is net domestic product at market price? When you gross domestic price, if you want to get a net, you have to deduct the depreciation from the gross domestic product of the market price. GDP at market price minus depreciation is NDP market price. Therefore, net domestic product is nothing but gross domestic product market price. You have to deduct depreciation from the GDP market price. When you deduct depreciation from GDP market price, you will get net. Net means you are deducting something. What you are deducting something here? Depreciation you are deducting something. Therefore, here net indirect taxes mean you are deducting something. What you are deducting? From indirect taxes you are deducting subsidies. Here net domestic product means you are deducting something. What you are deducting? From GDP market price you are deducting depreciation. All these macroeconomic variables you have to define for this answer, macroeconomic identities. I hope you understood. And the next one, GNP market price. GDP, this is another indicator. GNP, that is gross domestic product. This is gross national product. GNP. What is GNP? GNP market price is nothing but it is an identity sign. Is equal to, or identity is exactly equal to GDP plus factor income earned by the domestic factors of production employed in the rest of the world. That, for instance, factor income earned by the domestic factors. For instance, the citizen of India is working in Saudi Arabia as an accountant. A lady working as an accountant or a doctor or a nurse in Saudi Arabia. Therefore, she is a citizen of India. Therefore, factor income earned by the domestic factors, because even she is a citizen of India, but where? In the rest of the world, where is he is working? In Saudi Arabia. Therefore, that income we have to add, because that income should come to India, minus factor income earned by the factors of production of the rest of the world employed in domestic. For instance, a Korean carp factory is, they own the land and all the factors of production, and they are producing cars in India, but they are citizens of Korea. Then the profit earned should go to their country, even though the production takes place in domestic economy in India. That is what factor income earned by the factors of production of the rest of the world, that is Korea, employed in domestic economy, that is they are producing in India. In that case, the factor income earned is profit should go back to Korea. In this case, our citizens of India working in Saudi Arabia, then their income earned as salaries or profit should come back to India. That is what they are telling. GDP, that is added to the GDP. Foreigners' income is deducted, minus. I hope you understood. Therefore, GNP, that means gross national product, is nothing but GDP market price plus NFIA. NFIA in the sense net factor income, net factor income of from abroad. Abroad means from foreign countries. That is what it is denoted by NFIA. I will explain. When you add GDP market price with the NFIA, you will get GNPME. That is what exactly it is mentioned in this chart. GDP plus factor income minus factor income earned by domestic resources in the rest of the world minus factor income earned by the factors of production rest of the world employed in domestic economy. This will give you NFIA. NFIA is nothing but this minus this minus this will give you NFIA. I hope you understood. Factor income earned by the domestic resources which are employed in the rest of the world, that is citizens of India working in another countries, but their income is coming to India GDP minus factor income earned by the resources of the rest of the world, but those resources are employed in domestic economy. For example, a Microsoft from USA working in India industry, IT industry, that profit earned by the Microsoft industry will go back to USA only. It will be deducted from the GDP of India. That is what it is given as net factor income. Therefore, when you deduct the factor income earned by the domestic resources employed in rest of the world minus factor income earned by the rest of the world resources employed in domestic economy, you will get NFIA, net factor income earned from abroad. Therefore, GNP factor cost is what? Then now GNP market price, GNP at market price we have calculated. Now, because GDP never take into consideration the income from abroad, it only always GDP take the income within the domestic territory. The adjustments for taking income from abroad is included in GNP. Therefore, GNP market price is there, you know. Now, GNP at factor cost, how do you will do? GNP at factor cost is nothing but GNP at market price minus net production taxes minus net product taxes minus net production taxes. That means factor cost nothing include any taxes. Therefore, all the taxes you have to deduct from the market price, then you will get factor cost. GNP market price, you know, from the GNP market price, you deduct all the taxes, net production taxes minus net product taxes, you will end up factor cost, because factor cost doesn't include any taxes. Therefore, it is easy to remember GNP factor cost is nothing but GDP at market price. From the market price, you deduct all the taxes, net product taxes minus net production taxes. I told you two different taxes. I hope you understood. And the next one, NNB market price. In net, we always want to see calculate any net, you are going to deduct something. Here net national product, this is gross national product. GNB is gross national product. GNB gross national product. What is NNB? Net national product. Net, this one is nothing but net national product. Net national product. Net national product is what? GNB, NNB, net national product market price is equal to GNP market price minus depreciation. You are subtracting this depreciation, then you are getting net national product. When you get something net, you have to deduct something. That is, you are deducting depreciation. Then you are getting net national product. And net national product at market price also calculated in another method. That is, maybe one is GNB market price minus depreciation, or NDP market price plus NFIA. That is, net domestic product at market price plus net factor income earned from abroad. If you add for the domestic product, net factor income earned from abroad, you will get net national product at factor cost. You see, GNP if you want, you have to get GDP plus NFIA. You have, with the domestic product, cross domestic product, you have to add the net factor income earned from abroad. Here, to net national product also, here instead of NDP, GDP, you are adding net domestic product, NDP plus NFIA. I hope you understood. And now I am explaining what is this, that we have used this term NFIA, net factor income from abroad. Net factor in factor IA abroad. What is that? Factor income earned by, it is equal to factor income earned by the domestic factors of production employed in the rest of the world, that is Indian citizens working in abroad and sending their income to profit and income earned in their foreign countries to India, that is included Indian GDP, minus foreigners working in India and they own the factors of production and earn the profit. Those profits are deducted from GDP of India, that is factor income earned by the factors of production of the rest of the world employed in the domestic economy, earned by the factors of production of the rest of the world employed in the domestic world. I hope you understood, you are clear about it. And the next one, before going that, therefore we know what is GNP, it's identity sign. I said any variable might be there either side, right side or left side, it always holds good. Therefore GNP is exactly equal to GDP plus net factor income from abroad, NFIA. I hope you are clear, because this is the one I will explain. Now you can see this is a domestic economy, it is in your textbook, domestic economy, that if foreigners are working, that means, but if it's a foreigners are working in domestic economy using their skill and the knowledge and the factors of production, what will happen? The profit will go to their country, foreigners. And profits earned by a Korean owned car factory in India will have to be subtracted from the GDP of India, because the profit is going to Korean, that country's GDP, not India's GDP. Therefore, we have to subtract the Korean owned car factory India, the profit of the Korean owned car factory which is working in India. You hope understood, because it is not belong to GDP of India, it belongs to their country. Like that, our people working in abroad, that income and the salaries and profit doesn't belong to that country, it has to come to India's GDP. That's what. If we deduct depreciation from GNP, that's what I have already told, that if we deduct depreciation from GNP, we have already seen GNP minus depreciation will give us NNP, net national product. NNP mean net national product. I have already explained that. And NNP market price is nothing but GNP market price minus depreciation. Note, all these variables are evaluated at market prices. Market prices mean whatever the price consumers are paying while purchasing the items. That means including the taxes. Value of NNP evaluated at market price, because that is what NNP market price. The next one, but market prices includes indirect taxes. You know indirect taxes, production taxes and product taxes. It's charged to the prices indirectly. When indirect taxes are imposed on goods and services, their prices will go up. That's why we pay more price when we buy items, because the prices includes the indirect tax also. Indirect taxes accrue to the government. What they do, the shopkeepers and all, they charge the prices from us, and part of the tax is paid by those shop owners or entrepreneurs back to the government. Therefore, indirect taxes accrue mean received by the government. It goes back to the government. It goes to the government as an income of the government. NNB at factor cost. Very, very important identity. Again, this macroeconomic identity variable, this one, you have to mention about in your answer. NNB at factor cost is nothing but exactly equal to national income of the nation. National income is nothing but NNB, net national product at factor cost. You have to be very much clear about it. What is national income? National income is a macroeconomic variable which is NNB at factor cost, measured at factor cost. Therefore, NNB measure at factor cost, how do you will calculate? Factor cost means no taxes. What you will do? From NNB market prices, you will deduct all taxes. That means NNB at market prices minus within bracket indirect taxes minus subsidies. That means what will do? Indirect taxes are what? Net production tax, production tax. You can two things you have to, production tax and product tax, and as well as production subsidy and product subsidy. You know, production tax minus production subsidy is nothing but net production tax, and product tax minus product subsidy is nothing but net product tax. Therefore, what you will do? NNB at market price, this indirect tax minus subsidy can be denoted by NIT, net indirect tax. Net indirect tax is nothing but indirect tax minus subsidy. When you subtract subsidy from indirect tax, it is called net indirect tax. I told if you are finding any net, you are subtracting something. Here, net indirect tax, this instead of indirect tax minus subsidy, we can just put one word, NIT. That is what we are going to see. So you see, NNB minus indirect tax minus subsidy, we are writing what? NNB market prices minus net indirect taxes. You know what are the net indirect taxes? Net indirect taxes, nothing but I told you indirect tax minus subsidy. If you subtract subsidy from indirect tax, you will get net indirect tax. And therefore, what you can write? NNB at factor cost, or very important variable in national income, is nothing but NNB at market price minus net indirect taxes. We have both two net indirect taxes. What is that? One is net production tax. Net production tax means production tax minus production subsidy, net production tax. Another one is what? Net product. Here it is production. Another tax is I already told product. PUC, product tax. Therefore, all the indirect taxes minus subsidies we can write in this form. NNB minus market price minus net product tax minus net production taxes. I hope you understood. Indirect taxes mean net production tax, net production tax, net product tax. Subsidies mean net production subsidy, net product subsidy. Therefore, from net production, I will put like that, production tax minus production subsidy, what you will get? Net production tax. That only we are writing, net production tax here. And when you subtract the indirect tax, what is other type of indirect tax? Product tax. Product tax minus product subsidy, what you will get? Net product tax. Production tax minus production subsidy, what you will get? Net production taxes. I hope you understood. Therefore, from NNB market price, you deduct both the net production tax minus net product tax, you will end up with the NNB at factor cost. NNB at factor cost, net national product at factor cost is nothing but national income of the nation. I hope you are clear. And personal income. Now, this is also one of the macroeconomic identity, personal income. Personal income is nothing but part of the national income received or accrued to the households. Therefore, then from national income, if you deduct undistributed profit, UP, undistributed profit means the profit which is deducted from the national, it is the profit of the firms or government enterprises earned by the firm and government enterprises, but which is not distributed for the factors of production. It is kept with the firm and enterprises for further expansion. That type of profit is called as undistributed profit. Therefore, NI minus undistributed profit minus net interest payment, because it is minus, because this is doesn't go to the household. It doesn't paid by the firms or enterprises to the factors of production. Therefore, it is deducted because it doesn't go to the household personal income. Therefore, you have to minus it, undistributed profit, minus net interest payment made by the household. What do you mean by net interest payment made by the household? Household, if they would have already advanced some loans to the government or other firms, what they will do? They will receive the interest. They will receive the interest. They receive interest. On the other hand, if they would have incurred some loan from the firms or government, what they will do? They will pay the payment of interest. They will pay, household will pay the interest. Household will pay. When the household will pay the interest, when they incur some loan or debt from the firms or government, they have to pay the interest. On the other hand, if they would have advanced some loans for the firm or entrepreneurs, what they will do? They will receive the interest. That is what you say net interest payment. Received minus paid. Net interest payment of the household, I hope understood, minus corporate tax. What is corporate tax? The corporate tax is imposed on the earnings of the firms or entrepreneurs. Corporate tax is imposed on the earnings or the entrepreneurs, corporate tax, plus transfer payments. You know, here you can see corporate tax also we are deducting because it doesn't go to the household. And here only one factor we are including, adding, is transfer payment. What is transfer payment? Transfer payment is a one-way payment. It's not necessary to pay back again. That is given by in the form of pension or scholarships or gift or grant to the household by the government or other firms as a assistance. It is called transfer payment. It is received by the personal household. Therefore, it is added. Therefore, these are the factors. When we deduct from the national income undistributed profit minus net interest payment made by the household minus corporate tax and add transfer payment, then you will get personal income. This is the one of the macroeconomic identity or indicator. I hope you understood. Therefore, personal income is part of the national income which is received by the household. These are the, after deducting, adding everything, they are deducting from national income, they receive something that is called personal income. And undistributed profit is part of the profit which is not distributed among the factors of production. I told you, it is kept by the firm itself for further expansion. Therefore, we are deducting from national income because it is not distributed, therefore it will be received by the household. And the corporate tax which is imposed on the earnings of by the firms will also have to be deducted because it goes to the government. And since it doesn't accrue to the household, but it is accrue to the government. And net interest paid by the household to the firms and government have to be deducted. That is what we deduct from the NI. Transfer payment received by household from government and firms such as pensions, scholarship prices, for example, they have to be added because they are coming as an income to the household. Therefore, it is included plus added to the personal income, national income. Therefore, transfer payment have to be added to calculate the personal income of the household. Now, this is another microeconomic identity, PDI, personal disposable income. What is personal disposable income? PI, personal income minus personal tax payment minus non-tax payment. Therefore, personal disposable income is all the amount will not be spent by the household because they have to pay taxes, income tax like that. Therefore, from the personal income, to get a disposable income means it's absolutely is available for their spending by the household. Therefore, if you get that amount to personal disposable income, what you have to do from the personal income, you have to deduct the personal tax, example income tax of the individuals, minus you have to also deduct non-tax payments. These are the fines, penalties to the government, fines or penalty paid to the government. That also you have to, non-tax payments as well as tax payments should be deducted from personal income to derive personal disposable income. I hope you are clear. And these are the assignment, NNB, GNB, all this discussed in this slide. Please attend these questions and also as Bhagavan's quotation, Bhagavan Sri Sathya Sai Baba's quotation, see no evil, see what is good. From your young age only, you always develop all these virtues. It would always be very helpful in your life long journey and get the grace of God and be safe in your life. Hear no evil, hear what is good. Talk no evil, talk what is good. Don't waste time talking unnecessary thing. Think no evil, think what is good. Good thoughts, like a good food for the body, good thoughts for the mind. Do no evil, do what is good. This is the way to God. Bhagavan says Satya Sai Baba. Thank you all. Sai Ram.